Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. This Albert Einstein quote beautifully captures the essence of our topic, not with interest, but through dividends. To be more specific, through DRIP, or Dividend Reinvestment Plan, a simple yet powerful tool in the investor's arsenal. This method turns small, consistent investments into significant wealth over time, like a magic money tree that keeps growing and giving you more money over time. In this video, we're going to unlock the secrets of DRIP and how it can help you maximize your dividends and grow your wealth over time, different strategies to use it, and in the end, I'll show you and John some stocks that'll add an extra $4 million to John's investment using DRIP. So let's first understand dividends. When companies make profits, they sometimes share a part of these profits with their shareholders. This share of profit is called a dividend. Usually, when you get a dividend, it's paid as cash, either through a check or directly into your bank account. Next, you can cash out the dividend or reinvest in the same stock or another stock. This is called the Dividend Reinvestment Plan, or DRIP for short. So instead of getting cash, you get more shares. These extra shares are often purchased directly from the company's own stockpile, not from the stock market. One of the best things about DRIPs is that they often let you buy these extra shares without paying a commission or just for a small fee. Plus, you can usually get them cheaper than their current price on the stock market. There's often a minimum amount you need to reinvest, but it's usually not very high, often around $10. While DRIPs are generally for people who already own shares in the company, some companies let new investors use DRIPs too. They might just ask you to buy a certain amount of shares to start with. A DRIP is a plan offered by companies or brokers that allows investors to automatically reinvest their cash dividends into more shares of the company's stock, often without paying additional brokerage fees. The key difference between DRIPs and manual reinvestment lies in automation and convenience. With a DRIP, the reinvestment process is automatic. You don't have to actively use your dividend money to buy additional shares. The system does it for you. In contrast, manual reinvestment requires you to actively take your dividend payouts and reinvest them yourself, which can be time-consuming and may incur additional transaction fees. Still, either way, the strategy can add millions to your portfolio, something we'll show you in the end. DRIPs can be offered directly by companies or through brokerage accounts. Many well-known companies offer DRIPs to encourage long-term investment in their stocks. For instance, large corporations like Coca-Cola or Johnson & Johnson have DRIP options. Brokerage DRIPs provide more flexibility, allowing you to reinvest dividends from any company's stock that pays dividends. And the beauty of brokerage DRIPs is that they let you diversify, as you can reinvest dividends across different stocks. This strategy can be particularly powerful in building wealth over the long term, tapping into the magic of compounding or snowballing your investment without the hassle of manual reinvestment. Speaking of snowballing, that brings us to the question of why actually use the strategy in the first place? Investing through a DRIP offers several key advantages that can significantly impact your financial growth and stability. To truly appreciate the power of dividend reinvestment plans, DRIPs, it's helpful to look at some examples. Let's examine a few examples of stocks and how DRIPs could have enhanced their investment returns over time. Keep in mind that past performance is not indicative of future results, but these examples can provide a clearer picture of DRIP potential. For instance, let's take a hypothetical utility company, Utility Co., known for stable and regular dividends. It has a history of paying an annual dividend of $2 per share. If you had 200 shares of Utility Co. at $50 each, your annual dividend income would be $400 from a $10,000 investment. By reinvesting these dividends, you could purchase an additional 8 shares each year, assuming no change in share price or dividend amount. Over 10 years, without accounting for stock price appreciation, your share count could grow to about 280 shares, worth $14,000, paying $560 in dividend income. It grows faster each time, After 10 years, you'd be able to buy 11.2 shares with a $560 return. So after 20 years, you'd have 280 shares plus 112 more, totaling 392 shares. These would pay an annual dividend of $784, while the investment's worth grows to $19,600. At the 30-year mark, you'd have 549 shares, paying $1,098 in dividends, and an investment value of $27,450. The growth from years 20 to 30 is even more significant than from 10 to 20. Why? Because the larger number of shares you own in year 20 generates more dividends, which allows you to buy even more shares in year 30. That's the compounding effect in action, a small snowball that grows into a big financial portfolio over time. By automatically reinvesting dividends, you're buying more shares, which can lead to more dividends, creating this cycle of growth. Whether it's a stable utility, a growing consumer goods company, or a tech giant, the power of compounding through DRIPs can be a game changer in your investment strategy. Now remember, this example assumes the stock price remains the same and the dividend does not grow. If we take that into account, then the return is even more massive. We'll show you in the end how much a difference that can make. Another advantage of DRIPs is their potential tax benefits. While dividends are generally taxable, reinvesting them might defer taxes on these earnings until you sell the shares. This means you're not paying taxes each year on your reinvested dividends, allowing your investment to grow tax-deferred. Lastly, DRIPs are particularly well-suited for long-term investors. Since the focus is on gradual growth and reinvestment, it encourages a long-haul perspective. It's a commitment to grow your investment steadily and patiently, like nurturing a garden rather than seeking quick, short-term gains. In the end, we will show you some stocks and you'll see how DRIP can make an over $4 million difference. But first, let's see how you can maximize your returns using the DRIP strategy. To make the most of your dividend reinvestment plan, it's crucial to adopt strategies that not only enhance your dividend income but also align with your financial goals. Here are some practical approaches to optimize your DRIP investments. First, select the right dividend-paying stocks. Choosing suitable stocks for DRIPs is the first step toward maximizing your dividends. Look for companies with a strong track record of paying consistent and increasing dividends. Stability matters. Companies in well-established industries often offer this. The best place to start is by looking into dividend aristocrats or dividend kings who've been paying dividends for the past 25 and 50 years, respectively. These companies have not only been paying dividends consistently, but have also been increasing them for consecutive years. This serves as our second metric for selecting the right dividend-paying stocks. Additionally, thirdly, consider the stock price appreciation that dividend kings and aristocrats typically bring to the table. In the end, I'll show you what kind of stocks work best. Once you have the right stocks, you have to do regular monitoring and adjusting. Setting up a DRIP is not a set-and-forget strategy. Regularly review your investments to ensure they still meet your objectives. Market conditions change, and so might the prospects of the companies you've invested in. If a company's financial health deteriorates, it might be time to redirect your DRIP to a more promising stock. Then there's diversification, the key to stability. It's crucial in any investment strategy, including DRIPs. Don't put all your eggs in one basket. Spread your investments across different sectors and industries to mitigate risks. For instance, instead of investing solely in tech stocks, consider diversifying into healthcare, consumer goods, or industrial sectors. This approach can protect your portfolio from sector-specific downturns. And now, it's time for you to see the big picture itself. First, let's select some dividend stocks that have a good starting dividend yield, a good dividend growth rate, and a good average annual share price appreciation rate. For me, the stocks that tick all these boxes are low, and T. Rowe. And before seeing how much a drip strategy can add to our value in these stocks, let's get to know them first and why I like them. Starting with Lowe's Companies Incorporated, known by the ticker symbol LOW. This stock is one of the top choices when it comes to dividend stock investment. And it all makes sense when you look at the metrics. It has a dividend yield of 2.08% with a strong dividend growth rate of 20.04%. And for capital appreciation, it has one of the best average annual growth rates of 16.49%. Lowe's has a great record of increasing its dividends for 52 years straight. Now, let's see a side-by-side comparison of John's investment in this stock without dividend reinvestment and with the DRIP strategy. Let's break it down. First, no dividend reinvestment. Say if John invests $10,000 in this stock with no DRIP. After 1 year, the investment rises to $11,649. As John waits 10 years, the investment is projected to reach $46,014. After 20 years, the portfolio value will reach $211,725. At the 30-year milestone, John's initial investment reaches to an impressive $974,225, paying $47,840 in annual dividends or $3,987 monthly. The overall addition to his portfolio is $1,243,001, with $964,225 from stock value increase and $278,776 of total dividends cashed out, leaving his final investment valuation of $974,225. Now here's what the portfolio will look like if John uses the DRIP strategy. After 1 year, the investment rises to $11,857. After 10 years, the investment is projected to be almost six-fold and reach $56,639. Give it 10 more years, and after 20 years, the portfolio value will reach $349,416. At the 30-year milestone, John's initial investment balloons to an impressive $2,430,138, paying $113,747 in annual dividends or $9,479 monthly. The overall addition to his portfolio is an extraordinary $2,420,138, with $1,863,942 deriving from stock value increase and $556,196 from reinvested dividends. Comparing the two, you can see the DRIP system has added $1,455,913 to John's portfolio over 30 years. And this difference is even more apparent when you look at the future projections of T. Rowe Price Group's stock. T. Rowe is one of the most attractive dividend stocks you can find. It has a dividend yield of 4.38%. An average annual return of 3.34%, and a 10-year dividend growth of 12.37%. This stock checks all the boxes of a dividend stock. It might not have high stock price appreciation, but it helps John buy more shares at a lower price and significantly compound the dividend income. Let's see the projection with no DRIP first in this stock. After 1 year, his investments will grow to $10,334. In 10 years, his investment will increase by $13,889. In 20 years, it'll be valued at $19,292. And in 30 years, it'll be valued at $26,795. This stock will add $137,240 to his investment, in which capital appreciation is $16,795 and dividend cashed out is $120,445, leaving his ending balance at $26,795. On the surface, it looks like a bad investment, but his stock has something not most stocks have: a strong starting dividend yield of 4.38%, and a strong dividend growth of 12.37%, something the DRIP strategy thrives on. Here's what these numbers would look like if John, instead of cashing out dividends, would choose to reinvest them instead. After 1 year, his investments will grow to $10,772. In 10 years, his investment will increase by $25,918. If he holds his investment will be valued at $148,792. From here, the snowball of massive dividend growth at 12.37% starts to take effect. And with dividend reinvestment, after 30 years, John's investment will grow massively to $4,489,523. This stock will add over $4,479,523 to his investment, in which capital appreciation is $319,818 and value added through dividends is $4,159,706. This means, with the DRIP strategy, this stock has added an extra $4,462,728 over the 30 years. Impressive. Now that you know the value of DRIP, watch our video on the top 9 dividend stocks for 2024 to maximize the return.